Checking account? Yep. My dad's old GTO? Count it. My Beanie Baby collection? I like to call them assets. Today is all about what you own and what you're worth, aka your assets. You probably know that your income and debts are important when getting a loan, but things you own, they matter too. We're going to talk about why assets are important, give you an idea of what to include on your loan application, and show you which assets lenders love the most, so you can qualify for more and get lower rates. Spoiler alert, it's not Beanie Babies. Assets are anything you own that's worth something. They play a big part in calculating your net worth. To calculate your net worth, add up all your total assets and subtract all of your outstanding debt. For instance, if you have $25,000 in the bank, an IRA with $12,000 in it, but owe $20,000 in student loans, your net worth is $17,000. Lenders care about your net worth because it gives them an idea of how likely it is you'll eventually pay off your loan. If you have a lot of assets and lose your job, chances are you can just sell or withdraw some things and be fine to meet your obligations. But if you don't own anything and have a low income, losing your job could mean bad news for you and your lender. All of that consideration is what the pros like to call risk analysis. It determines how much lenders feel comfortable loaning to you and how much they plan to charge for it. There are a lot of categories you may see on a loan application. We're going to cover the main ones, but in general, include as many as you can. Cash and cash equivalents are as simple as they sound. Anything that can be instantly withdrawn counts here. The money in all of your checking or savings accounts, any money market accounts, CDs, certificates of deposit, and so on. Non-physical assets are a broad category of anything intangible. Assets like IRAs, 401ks, patents, royalties, life insurance policies, any long-term financial asset that gives you a bit of cushion in case things go sideways. Non-physical assets aren't as liquid. You can't convert them into cash as easily, but they're good for your lender to know about. Plus, you can sometimes borrow against these assets if needed. Liquid assets are a subcategory of non-physical assets that you can instantly convert to cash, like bonds or stocks. If you can quickly sell them on the market and walk away with cash in hand, then that's a liquid asset. Side note, you may be thinking, well, what about my physical assets? My art collection is worth money, or how about my boat? Well, you'll want to talk to your lender about those. Fixed assets are any physical assets that you can sell, but it would take time to do so. Things like an investment property or vacation home. Equity assets are a category that includes retirement accounts, stocks, and mutual funds. And lastly, fixed income assets include any investment funds that have been loaned in exchange for interest. This typically includes government bonds and some securities. I just covered a lot. If you are unsure where to put a certain asset, just ask your home loan expert. Lenders look at everything you own, but they definitely put more weight on certain assets. Homes over Beanie Babies, for instance. If there's one thing they love more than anything else, it's liquidity. The easier you can turn something into cold, hard cash, the more a lender will care about it. That's because if you're about to miss a payment, they know you can easily liquidate something to pay it back. Okay, but how do they know you're telling the truth? First, after you've categorized all your assets on your mortgage application, lenders will look at bank statements and various transactions and contact your banks to verify that what you're saying is accurate. In general, you should just try to make your income as traceable as possible. Have a paper trail that is easy to match to what you're saying on your mortgage application. If you have a history of cashing checks, instead of depositing them, then withdrawing, start doing that instead. They'll also check your overdraft history, since that's an obvious red flag. Then they may ask to see a professional appraisal report or insurance policy on any of the assets, like property or collectibles. If you have a lot of random assets in different places that you think could be interpreted as strange, it might be a good idea to schedule an appointment with an accountant to review your assets and make sure there are no red flags that might stop you from getting your loan approved. We get a lot of questions about this, so we're gonna rapid fire some answers at you. Yes and no. Unless you're retired, assets are just a part of what a lender looks at. You usually need an income as well to prove you can pay things back. unless you have just a lot of liquid assets. Yes, it will definitely be considered on your application, but if you plan on withdrawing or leveraging it, talk to a financial professional just to see what the tax penalty would be. The specific documents you need will depend on the type of asset, but brokerage statements, bank statements, and appraisal reports are commonly used to show proof of assets. Bottom line, list everything. Every bid helps to lower rates and boost your chances of being approved. And be prepared to prove that you own them and they're worth what you say, regardless of what it is. Ready to see what kind of mortgage you can get approved for? Start listing the assets you have and then head over to Rocket Mortgage to see what you qualify for. Thanks for checking us out today. If you'd like to see more videos just like this one, you know what you can do? Click right here. And as always, like and subscribe. We'll see you next time.